I turned $1,000 into $2,300 using a simple leap option strategy. And no, this wasn't some risky YOLO trade. It was a calculated, repeatable strategy that I use all the time. In this video, I'm going to be breaking down exactly how I structured this trade, why I chose it, and the risks that you need to be aware of before trading leap option strategies yourself. Most importantly, I'll explain why this strategy works even if you're trading with a small account. If you're new to my channel, I'm Eric Pan, a full-time investor holding mostly stocks and crypto in my portfolio. While managing my long-term positions, I also have a few short-term option strategies that I rinse and repeat regularly to generate more cash for my portfolio. We're gonna go step by step for number one. I'll explain what a leap option is. Number two, why I picked CrowdStrike stock for this leap option. Number three, how I set up this trade with controlled risks. And number four, most importantly, how you could use this strategy yourself. If you're ready to learn and incorporate this strategy in your portfolio, make sure to give this video a like and let's dig in. So first, what is a leap option? Before we get into the whole trade breakdown, let's quickly go over what a leap option is and why it's such a powerful tool for investors. LEAP stands for Long-Term Equity Anticipated Security. It's just a fancy way of saying long-term option contract. Unlike a short-term option that expires within a few weeks to a few months, LEAPs gives you exposure to a stock for much longer periods, typically about a year or longer. So why does this matter? Because longer expiration dates means that you have more time for your trade thesis to play out, reducing the impact of short-term market noise. Think of LEAPs as a way to get leveraged exposure to a stock without needing tens of thousands of dollars to buy 100 shares outright. Let's break it down with CrowdStrike, the stock that I used for this trade example. Buying 100 shares of CrowdStrike at $380 would require $38,000. But with my call contract, I controlled 100 shares with just $1,090. And that's how much it cost me to open up this one trade. And as for how much I'm actually risking in this trade, stay with me, we'll break it down there too. This is the beauty of LEAPs. You get nearly the same exposure of owning those shares, but at a fraction of the cost. Instead of tying up $38,000 of cash in a single stock, I allocated just slightly over $1,000 and still captured the upside. Let me explain another simple math with you. As you can see from this total return from this trade, I made a little over 209%. If I was trying to make that same return using shares of CrowdStrike stock would have had to move from $390 up to $1,200 per share, which is nearly impossible within a short term. So this strategy takes advantage of volatility of options using relatively small amount of capital. And the key is that I wasn't trying to buy a lottery ticket. I had a thesis going into this trade, and I knew exactly when I would be taking profits and what conditions would make me exit my trade, cutting those losses if things went south. Here's a summary of the advantages of the leap option strategies under the right conditions. Lower capital requirements. You could participate in high quality stocks without needing a huge portfolio. More time for the stock to move. Unlike short-term options that decay quickly, LEAPs gives your investments time to grow. Higher risk to reward potential. If the stock makes a big move, your returns are amplified because of the built-in leverage. Now that you understand what a leap option is and why I use them, let's move over onto why I chose CrowdStrike for this trade. Why I picked CrowdStrike for this trade. When selecting a stock for a leap option trade, I have three fundamental stock selection criteria. A fundamentally strong company with long-term growth potential, a stock that is in an upward trend or showing strong momentum, and a clear reason why the stock could move higher over time. Sound familiar? Those are the same criteria that I would look for in terms of value investing. Even though I use options to aim for short-term returns, CrowdStrike checks all of those boxes off for me, and it was also a stock that I was personally holding as well too. CrowdStrike is a leader in cybersecurity, which is one of the fastest growing industries. As more businesses move online, the need for AI-powered security solutions is skyrocketing. In 2024, there was a major fundamental catalyst taking place on CrowdStrike stock, the major outage that disrupted daily lives, businesses, and governments around the world. Many industries were affected, including airlines, airports, banks, hotels, hospitals, you name it. The operational crisis resulted in the crash of CrowdStrike's stock price, but was it a permanent damage to the company? I don't think so. If you cared to research the fundamentals of this company, there are three good reasons to believe that CrowdStrike's dip was only temporary, and it was most likely going to rebound. Consistent revenue growth. CrowdStrike has been reporting strong earnings, growing its customer base, and increasing market share. Strong institutional backing. Large funds and institutions have also been buying and holding up shares, which is a bullish signal. AI-driven cybersecurity. With the rise of AI, CrowdStrike is well positioned as one of the dominant players in security software. Now, fundamentals alone isn't enough. I also look at the stock's price action. At the time I entered this trade, CrowdStrike had formed a clear reversal uptrend from its bottom since the crash with strong momentum. Now, what do I mean by momentum? On the stock chart, the price had broken through key resistance levels and making higher highs. I wasn't trying to guess the bottom or calling CrowdStrike to hit the moon. I was just simply following a setup where the stock had room to run. The setup is simple. I joined the bullish trend before the reversal had formed, and there was still room before the stock moved back to its previous highs. This made CrowdStrike an ideal leap candidate because it had strong fundamentals, bullish price action, and momentum backing it up. When trading leaps, you need to have conviction in the stock's long-term upside. I believed in CrowdStrike's ability to continue growing over the next 12 months. Cybersecurity spending has been increasing, their earnings have been strong, and they've been expanding their product lines. This wasn't a short-term hype play. This was a calculated decision based on solid research. All of my analysis on this stock, as well as my real-time buys and sells actions, were shared within my investing community members. I have a structured investing program, and I share all of my portfolio updates backed by research and data. But if you would like me to send you free stock picks and investing ideas weekly, you can click the link below in this video to join my free newsletter. I've been sending out stocks and crypto investing ideas every single week to thousands of subscribers, so make sure to grab your copy too. My trade setup, how I structured this leap option trade. Let's break down my entry, exits, and risk management. The key to trading leap options successfully is having a clear plan, knowing your expiration dates, strike price, and how much risk that you're willing to take. For this trade, I picked an April 17, 2025 expiration date that's nearly 1 year out from the time I bought this call. Here's why leaps matter. More time equals less pressure. Unlike short-term options that can lose value quickly, leaps gives your stock more time to move in your favor. Less theta decay. The biggest killer to options is time decay, also known as theta in options, but leaps decay much slower than short-term contracts. I have a longer time frame to stay in the trend. CrowdStrike's stock didn't need to explode overnight. I had time for my thesis to play out. Now, here's my personal secret. Pay attention now. When I'm trading my leap strategies, I look for out of the money call options for higher return potential. This means I look for a strike price that is higher than where the stock is currently trading at, so the call is out of the money. In this case, I selected the 390 strike price, which is out of the money when I bought it. So why did I do this instead of picking in the money contracts? Well, lower upfront costs. Out of the money leaps are much cheaper, so I can enter the trade with just $1,090. Balancing risk and reward. I didn't go for an extremely far out of the money strike because that would have reduced my probability of success. And the cost of the call option was just my initial investments. Just like any long-term investing, you have a book cost for all of your holdings. If you hold 100 shares of Tesla with an average price of $200, your initial investment cost would be $20,000. So does that mean you're going to risk all $20,000? Not really. Well, you would most likely sell your shares if an absolute bad news were to fundamentally change the value of the company. Likewise, when I'm using the leap option strategy, I have the cost to open up the contract, which is $1,090. To put things in perspective, you can only afford 2 shares of CrowdStrike with $1,000, which is not going to make you a whole lot of money. Whereas using options, every contract represents 100 shares, and I only had to pay $1,090. Now, my exit strategy involves when taking profits or cutting my losses. I exited when the contract price reached $33.70 per share, bringing my total value of my contract to $3,370. And that's how I made over $2,000 profit. How I determined taking profit was based on the stock price. I first bought the leap in September of 2024 when it was just trading at $285 per share. Meanwhile, the strike price of the leap was $380, nearly $100 higher than where it was currently trading at that time. I reasonably knew that it could return back to the levels where it was trading prior to the crash, so that was my take profit price. Once the underlying shares was approaching my strike price, that was an indication for me to sell. And that was where I felt comfortable with letting it go and taking the profits that I made. Here's the final profit breakdown. Total sale price, $3,370. Initial cost, $1,090. Total profit, $2,280. Total percentage gain, 209%. This was a textbook leap trade. I entered with solid thesis, rode the momentum, and locked in my profits when my target was hit. I could have held it longer and squeezed out a little bit more gains, but taking profits when you hit your target is key to consistent success. Now let's talk about something equally important: the risks to this strategy and how I managed to avoid blowing up my portfolio. Managing risks, what you need to know before trading leap options. Now, let's be real, no option is guaranteed to win. Leap options have a lot of advantages, but if you don't manage those risks properly, they can work against you just as easily. So let's break down the key risks to this strategy and how I personally mitigate them. And if you've been following so far on this tutorial, don't forget to give this a thumbs up. Number one, lower cost doesn't mean zero risks. One of the biggest misconceptions with leap options is that just because they cost less than buying shares, they're automatically safer. Yes, I only risked $1,090 instead of putting $38,000 into buying 100 shares outright, but if CrowdStrike didn't move in my favor, I could have lost a significant portion of that investment. So I only risked an amount that I am comfortable losing. Before entering in my leap trade, I asked myself, would I be okay if this went to zero? And if the answer is no, I'm risking too much. On top of that, my exit strategy was to sell my contracts if there had been a fundamental shift in my conviction for that company. This means any major news or financial issues that severely impacted the company. One of the benefits of leaps is that they decay much slower than shorter term contracts, but that doesn't mean time decay isn't a factor. As the expiration gets closer, if the stock isn't moving in your favor, your option will start losing value due to theta decay. Think of it as like an hourglass. Every day that passes, a little bit of value trickles away from your contract, especially if the stock is just moving sideways. That's why I don't hold my leaps until expiration. I always plan my exits ahead of time. If my thesis hasn't played out within a certain amount of period, I either take a small loss or roll my position into a new contract with more time. And number three, market downturns can hurt your leaps. Let's say CrowdStrike had dropped significantly instead of going up. That would have crushed the value of my contract. Even though leaps gives you time, if the stock fundamentally declines or never recovers, your leaps could expire worthless. So I don't just pick random stocks for leaps. I choose fundamentally strong companies that I believe in long term. This way, even if there's short-term volatility, the stock has a higher probability of bouncing back. So here's the key takeaway. Leap options are an amazing tool for compounding your money with lower upfront capital, but you need to have a strategy and a plan. Before you enter in trade, always ask yourself, number one, how much am I willing to risk? Number two, what is my profit target? Number three, at what point will I exit even if I'm wrong? If you don't have the answers to these, you're not trading, you're gambling. Now that we've covered the risks, let's move on to how you could apply this strategy in your own portfolio. Please share your thoughts about this option strategy tutorial with me. I would love to hear your personal insights about option trading and investing. If you have a relatively small amount of cash and you're seeing high conviction investing opportunities within the stock market, the leap option strategy can be really useful for you. You can often spend as little as a few hundred to a few $1,000s to capitalize on good stocks that is in a bullish run. Not only that, you get to risk smaller amounts of capital with higher potential returns, but make sure to revisit the risk management section of this tutorial and make sure to consider bookmarking this video if you're serious about taking this strategy seriously for yourself. If you're ready to take action and build wealth, check out the 7 steps to investing blueprint right over here.